Welcome to Financial Planning Day. We are very lucky to have Assessor Torres with us today, and he'll be talking about property tax changes for the County of San Francisco. He's got a lot of material to cover today, and so you can put any questions in the chat function, and I'll be monitoring that. And then when we get to the end, if I see questions that we haven't covered, we'll try to get through those. Thank you so much for joining us today, Assessor Torres.
Well, thank you so much for having me, Karen. I'm very, very excited to be here for this online financial planning day. Good afternoon, everyone. My name is Joaquin Torres, and I'm your elected Assessor-Recorder here in the City and County of San Francisco. And I wanted to say thank you again for joining us on this Financial Planning Day session that specifically covers what's known as Proposition 19. Before we dive into that, I just want to say in the chat section, my staff will be putting up contact information where you can reach out to us so that when I say those things, you don't have to just jump for them. They'll also be in the chat section as well, so you can pick those up and know how to reach out to us with additional questions that you may have around this issue. You can reach out to us on our website, etc., and you'll find that information in the chat section. So I very much want to thank, of course, the organizers, Chris Remedios, Karen Christensen, who just introduced me, and of course, the San Francisco Public Library for hosting what I know has been a great event and creates a valuable bridge for our residents, you, to connect with experts on key personal financial topics. May I see the next, the slide, please? Great, give me one moment. I just want to provide a disclaimer. You often hear this kind of disclaimer with sessions such as these in podcasts where financial information or legal information is provided and shared as a narrative. This information is provided as general information about Proposition 19. It's not intended to be a legal interpretation or be taken as official guidance or relied on for a purpose, but is instead presented as a summary of information for you. So Proposition 19 is a constitutional amendment in California. So additional legislation, regulations, statewide guidance are what's expected to clarify its implementation. And we get that guidance from the State Board of Equalization. If there's a conflict between the information that we provide here and the proposition or any legal authorities implementing or interpreting the proposition, the text of the proposition and the other implementing or interpretive authorities will prevail and take precedent. So we encourage you to take time to consult with an attorney as appropriate for advice on your specific situation. Next slide, please. So we're going to do a general overview where I can share some of the latest updates from my office, property and transfer tax revenue data, and then we're going to spend the bulk of time on Proposition 19. So just take a note that this is a slightly longer presentation, so it can include some common scenarios and some of the frequently asked questions that we often get when we talk about Proposition 19. And if you still have some questions, please reach out to us at assessor@sfgov.org, assessor@sfgov.org, which we'll put in the chat. So, and we can also share this presentation with all of you. So why don't we go ahead and get started? Next slide, please. So what is the Office of the Assessor-Recorder? It can be broken down essentially into the activities that you see here. Identify, discover, and assess all real property. We're responsible as well for transfer tax collection, which is the only tax rule that we have directly. We grant all property tax exemptions as required by law. And we record and maintain public documents. So we provide the most stable and secure source, or the basis for the most stable and secure source of funding for the City and County of San Francisco, which then goes right into the general fund dollars that pay for all of the vital public services that we rely on to have a healthy, vibrant, and successful city. Next slide, please. So as you've heard, I have two roles of the office. I'm the assessor, I'm the recorder. So we assess and we record. We ensure that there's a strong basis for the city's financial resiliency, as I mentioned. And on the assessor side, as I mentioned, We value all the property in the county, all real property, apply those exclusions and exemptions as required by state law. And it's about 211,000 parcels throughout the entire city and county. So just think if you're on a block or if you're at a park and you're overlooking the city someplace, or looking around at a certain view of the city and you see all that property. In totality, about 211,000 parcels, as well as about 37,000 business personal property accounts. And the latest data reflects years-long culmination of the great work of the team at the Office of the Assessor-Recorder, a great group of professionals who are dedicated to doing this accurate and diligent work. We do it in a timely way, we do it in a fair way, and we do it in a transparent way. And that's the continued mission that we have that guides us. The total assessed value of all of those properties and parcels that I mentioned is about $332 billion. That's assessed value. Then after a tax rate is applied to that value, it ends up being, as it did recently, meaning about $3.7 billion in property tax revenue for, again, those fundamental services such as education, our schools, our parks, our roads, emergency services that deal with issues providing resources for small businesses to nonprofits and other vital services that people provide for us, again, for San Francisco. In addition to doing that basic work of making sure we have that assessed value on a roll, is what we call it, we also have to apply all of the legal exemptions that are required by law. And that's about $20 billion of exemptions just for this year. And that ends up equaling about $230 million in property tax savings for homeowners, disabled veterans, churches, schools, museums, affordable housing projects, and charitable organizations. Earlier this year, in July, we mailed out the annual notices of assessed value, which includes those exemption values. So as you receive this information from our office, just make sure you're noticing that value that's placed in that notice, because that is what forms the basis of what eventually will be your tax bill that is sent to you by the treasurer and tax collector. So again, any questions, just go ahead and reach out to us. Then on the recorder side, again, just an overview of what we do. We're responsible for recording over 200 types of documents, real estate transactions, deeds, trusts. We hold that information, which is searchable, and we're seeking to increase access to that information, and then also marriage certificates. In the fiscal year of 21-22, we collected over $345 million in transfer tax. So transfer tax on the recorder side is created whenever there's a transaction, properties change hands. And that is both in a real physical way and sometimes in a paper way when there's a legal entity that is switching operational control. So that then results in the transfer tax being applied. So we want to make sure that everyone is also paying their fair share. And we audit transfer tax documents from large corporations, legal entity ownerships, and really make sure that we are capturing value that may be underreported. So since 2015, when we started taking this closer look and really making sure people were paying their fair share, we recovered and have recovered over $72 million in additional revenue for the general fund. So that's essential from our perspective in terms of making sure that people are paying their fair share and that we are doing our due diligence by abiding by the law to make sure we can capture that resource for the benefit of you. All right, next slide, please. So that's an overview of the office. Now let's move into what we wanted to talk about today, specifically changes to the state constitution that occurred back in November of 2020, and that is Proposition 19. As I mentioned, it's a state ballot measure that passed in November of 2020, and that changed the state's constitution, specifically Article 13A, Proposition 13, property tax law, that is the essentially the tome that guides us when it comes to property taxes, state rules, codes that we must follow. So before and since its passage, many people have been reaching out to our office to clarify what it means. They want help in understanding what and how their transfer desires have been impacted in some way. And it makes sense because it is a very complicated law. And it changed the rules for two types of reassessment exclusions. There are two basic components to Proposition 19, the base year value transfer, and then the other one is the intergenerational transfer exclusion, or what's called the parent to child and grandparent-grandchild transfer exclusion. So it's gonna get a little wonky, and I'll do my best to break this down in the most simple and direct manner possible. You can find that factored base year value that I'm talking about if you're a property owner on your notice of assessed value. And again, that is something that happens on an annual basis in July. So look for that. If you don't receive it and you're expecting one, please do reach out to our office to make sure that something hasn't been missed in the mailing process or otherwise. And remember to check that value. It's important for you to always do that. Mistakes can occur even with the best of systems. So please do pay attention to that and reach out to us. So if there's any corrections that need to be made, we can take care of that. And again, as I mentioned, any questions, reach right back out to us. Next slide, please. Okay, so what is the base year value transfer? The base year value law allows eligible homeowners, when they move to another home, to transfer their existing low factor base year value to that replacement home. Why is that important? Because if I bought a home for $200,000, let's say, and I want to move to a different area, there's going to be a change in ownership. A change in ownership triggers a reassessment. A reassessment measures market rate value at that time. And we all know how expensive homes are these days. And you can imagine how much your property tax obligation may increase. This component of the law addresses that. So the law now requires at least one event, sale, purchase of your home, to occur on or after April 1st of 2021. This date is then the operative date for the base year value transfer. And transfers can occur anywhere in the state, and each eligible homeowner can transfer that base year value up to 3 times. So there's no longer a limit to the market value of the replacement property. Before there was, so that's one good change. And before Proposition 19, the replacement home had to be at or below the original home's market value to qualify. So the change provides more flexibility in where you can go and making sure that you can still take advantage of that property tax savings that Proposition 13 had given you by maintaining a cap on how much on an annual basis your assessed value could increase. So it provides more flexibility to preserve that factor base year value for the replacement home. Let's talk about in the next slide who's eligible. So a homeowner has to meet one of the following criteria: age 55 and older, severely and permanently disabled, or a victim of a wildfire or a natural disaster. So those are some of the requirements as it relates to your person. Then there's about the replacement home and the timeline. The replacement home has to be purchased or newly constructed within 2 years of the sale of that original home. And the homeowner must occupy the original and the replacement dwelling as a principal residence, right? So typically that is defined as where you select where your homeowner's exemption is going to be, because that is your home, that's where you live, that is your principal residence. Next slide, please. So if you are curious as to what does severely and permanently disabled mean, according to the law in this case, you can see here on this slide. I'll give you a moment to read that. All right, next slide, please. All right, the filing period. Just to kind of keep in your head, because there's a lot of technicalities here. Remember that you don't have to remember all the rules, but you need to know where to go to find that information to make sure that you're in accordance with the law. Do that due diligence either directly or with someone that you're working with to make sure that you understand what your obligations are, and there are many. Timelines, details, information, additional actions that you have to take. You want to make sure that you kind of write those down so you have a place to make sure, and a checklist to make sure that you know that you've covered those bases. So to qualify for the base year value transfer, you have to file a claim for the transfer within 3 years after the purchase or completion of construction of that replacement dwelling. So you got to file that claim for the transfer within 3 years after the purchase or completion of construction of that new home. And then if you miss a deadline, there's some prospective relief that may be available to you, that is available to you. Next slide, please. Okay, so here's an example. There's no limit to the market value of the replacement property. So any amount of the replacement property above that original property's market value is added to the assessed value for a new base year value. So here's an example of what that means. Let's say there's an eligible homeowner, you're right, you qualify, over age 55, who purchases a replacement home for $1.5 million. 4 months later, she sells her home for $1.2 million. I don't know when that's going to happen, but let's just say it does. Her original home has a taxable value or factor base year value of $250,000. That was the amount that the value is at, and she wants to transfer that low base year value to her new home. So in this case, Proposition 19 can be some benefit, can provide some benefit. So the replacement home exceeds 100% of her original home's market value. So even though you have the flexibility to choose that home, which you did not before, there's still a ramification to making that choice. So because the overage or the excess market value is going to be added to her original taxable value. So in this example, you would see that the excess is $300,000. It's 1.5 million minus 1.2 million. And then that 300,000 will be added to that original factor base year value that you were carrying, that lower amount of $250,000, and that gives you $550,000. So that's going to be the basis on which your tax rate is applied, and then that will lead you and leave you with the tax bill. Note that while the base year value is not $250,000 in this case, it's also not $1.5 million or whatever that market value would be of the newly purchased home, which is what it would have been without this provision applied. So there is significant savings there, and by about 3 times, and that can make a huge difference on an annual basis for when you have to come up with those dollars to pay your property taxes 2 times per year, which is what the treasurer and tax collector notices you, sends you the bill about, right? Next slide, please. So why don't we go over some of the frequently asked questions that we have around some of these base year value transfers. So one is, I'm 54 years old. If I sell my home right now and I buy the replacement dwelling after I turn age 55, will I be eligible to transfer the base year value? The answer to that is no. Very specifically, you must be age 55 or over when you sell that original primary residence to qualify. You can purchase a replacement residence prior to age 55, but you must be age 55 or older on the sale of the original primary residence. Some of these elements don't always make sense, but those are the rules. And that's what the voter passed. And then there's been clarifying letters to us from the Board of Equalization to clarify that this in fact is the rule. So sometimes that is a case where you're like, well, why is that flexibility allowed here versus there? The answer is because it's in the law. Next slide, please. Timing. How long do I have to buy a replacement home after selling my original home? You have 2 years to purchase a replacement property that you will use as a primary residence. That's what the law states. Next question. So let's say due to COVID-19, you've not been able to construct a replacement property. Is there an exception? And that's been a debate that's been going on in the state legislature, but it hasn't been resolved yet. So the 2-year requirement is what is binding in the state constitution. And as of today, there are no exceptions. So that's where we are right now. Next slide. So let's say that there's a couple They bought that home and they divorce. As part of that divorce, the principal residence that they lived in was sold. Would each of the owners be able to transfer their share of the base year value to their respective replacement residences? AKA, can you cut it up in some way and then transfer that cut up base year value and apply it to a new home? The answer is no. Only one claimant may transfer the original property's base year value. If both parties qualify, they must mutually decide who is going to get that benefit. Next slide, please. Can I have a co-owner question? Can I have my child on title with me? The answer, yes. If you and your child purchase the property together from a third party, there is no requirement that the claimant be the sole owner of either the original primary residence or the replacement primary residence. So again, there's these nuances in the law that you want to pay attention to. If you're ever confused, ask the question so you can get clarity on what the answer will be to make sure you have the smoothest process possible. Next question, please. Which is, I sold my home and I purchased a 50% interest in my friend's residence. Am I able to transfer my base year value to my 50% interest? And the answer is no. Replacement residents did not undergo 100% change in ownership. So that is what is required, that 100% change in ownership. So that is the base year value transfer section of Proposition 19. And if there's time at the end of the presentation, we'll very happy to answer any more questions about that. But again, if you don't be shy. Just go ahead and reach out to us and send us information. Prop 19 is very complicated, very complex. It takes many times to go over it, whether you're a presenter on it or whether you are on the practical side of it, of trying to determine how it will apply to your situation. Reach out to us because it does help us inform how we want to share information, how we provide narrative and summary about Proposition 19 and what the rules are. All right, so now we're going to go to the second part of Proposition 19, and that is known as the intergenerational transfer exclusion. So let's talk about that. This is one of the more controversial elements of Proposition 19 among many communities, not only in San Francisco, but statewide, because it changes the rules that apply to transfers between parents and children and grandparents and grandchildren. This provision of the law became operative about 3 months after the law passed. And that was in February 16th of 2021. And it limits the property types and the value amount that a family can transfer to their children before a property reassessment is triggered, which then has an implication on your property taxes. So for example, Proposition 19 now says commercial property is no longer eligible for that exclusion benefit. Commercial property is no longer eligible for that exclusion benefit. That was taken away, which the voters voted on by 51%, a simple majority, during November of 2020. The property has to qualify as a family home or principal place of residence. And there is a cap to the amount excluded from the reassessment. So we're going to go into that here in just a moment. So next slide, please. So here's who qualifies as a child for Proposition 19. The definition of a child includes a person born of the parent, a stepchild, an in-law child, adopted, or a foster child. Next slide, please. So qualifications, again, principal place of residence, right? This is where you live. This is the home you have. And it's very clear when that is the case. So to be eligible, the person transferring the property, the transferor, must have lived in that property as their primary home. The one who receives the property, the transferee, must also claim that residence as their principal place of residence. So not a vacation place, not an income property that you'll rent on the market, but it is your principal place of residence. The transferee must file for the homeowner's exemption within 1 year of the home transfer. So you need to file for that homeowner's exemption to make sure that you can notice on there that it is your primary place of residence. The verification process goes on, but that is something that you must do as a transferee. So a transferee, again, the one who receives the property within 1 year of the home transfer. This is important because it's the requirement that's stated in the California Constitution, again, in that law, and there is no exception. Next slide, please. Okay, principal place of residence. So how do you show that? How do you verify that? You show that by filling out the homeowners or the disabled veterans exemption. So you can go to our website, sfassessor.org, sfassessor.org, and you can just fill out you can find those forms, click on the forms section, pull the ones out that you know are yours. Confusing to you, just call us, reach out to us, stop by, and ask. And it's important to know that an accessory dwelling unit, otherwise known as an ADU, and junior or junior ADU, those are eligible as a principal place of residence. So should a transferee, again, the one who receives, wish to occupy one of the units as their primary residence, the family home with the ADU is eligible for Proposition 19. I know that gets a little wonky. I'm not going to go much further into that, but if you have questions about that specific provision, reach out to us. See if you don't find the answers in the questionnaires. But again, we're always here to take your calls. Next slide, please. So there are some filing requirements that you want to keep at the top of your mind because they must be met. You want to note some different timing deadlines here. There's an exemption form for principal place of residency, a 1-year deadline, and number 2, there's an exclusion from reassessment claim, which has a 3-year deadline from the time of transfer. So this deadline only applies if the property has not been sold. So again, if deadlines are missed, there's prospective relief from the date of filing, only if the property is still owned by the transferee. And just remember, those timelines are important because the relief that you are seeking cannot be provided retroactively if you miss those deadlines. Okay, so let's go over some examples. Here's one. So there's a parent. They transfer their principal residence to their child on this very specific date, let's say March 1st of 2021. The child moves into the property and files for the homeowner's exemption and reassessment exclusion on February 1st, 2022. Both of those claims have been filed in a timely manner. The child is eligible for the exclusion as of the date of transfer on that date of March 1st, 2021. So both claims are timely filed. Eligibility occurs as of March 1st, 2021. That's when the property transferred. Next slide, please. So here's an example of someone who missed a deadline filing. Let's say a parent passes away, and this is something that happens. A parent passes away on June 15th of 2021. June 15th, 2021. The estate plan that was created leaves real property to a child. The exclusion from reassessment was filed on January 22nd of the following year, 6 months after the transfer occurred. The child moves into the home and files a homeowner's exemption on August 2nd, 2022, but that's over 1 year after the date of the transfer. So the exclusion claim, that was timely filed, but the homeowner's exemption claim wasn't, because it wasn't filed in that 1 year period. So the child can be eligible for prospective relief in the future, and the exclusion would apply as of the next lien date, which is the first of the year of every single year, as of the 2022 lien date for that 2022-2023 fiscal year. So it gets very complicated very quickly with the most simple of two options that you have there. You want to make sure that you are paying attention to those deadlines, because missing them can have implications for you financially. So what would happen here is that the child would have to pay a supplemental assessment for the year, which would be something that could have been avoided if you had timely filed those documents. All right, next slide, please. So this is about the value cap. So you had heard before what the rules were in the other provision in relationship to base year value transfers, where you were able to take that factored base year value, that $250,000 amount, move it to the new property, and then anything over the market rate value of that, or the market rate value of the new property that was over the selling price of the original property, that delta would then be applied to your factored base year value. So you'd still get a benefit. You have more flexibility in choosing maybe a more expensive property, but you'd still would be able to balance what your obligations are going to be financially, because the rule provided for that. But now let's look at this version. So Proposition 19 requires our office to apply a valuation test to the reassessment claim, exclusion claim. The value cap for the exclusion is a sum of the factored base year value plus $1 million. So the factored base year value, you add $1 million on top of that, and that becomes the value cap. And we'll show right now how that plays out. So any excess beyond that market value cap is then added to the new base year value as the new property's base year values. So somewhat of a similar formula there, but let's take a look at it a little bit more closely. Next slide, please. All right, so a death occurs on this date, June 2nd, 2021. The factored base year value of the home is $800,000. And the market value of the home is $1.6 million. So the property qualifies as a family home, so first step, and the eligible transferees filed both claims on April 15th of 2022. So to calculate the value cap, we take that factored base year value, that $800,000. We add the base year value of $800,000 to $1 million, and that we get the value cap, $1.8 million. So there's no additional market value added if the market value does not exceed the value cap. And in this case, since the $1.6 million market value is less than the value cap of $1.8 million, there's nothing else added. There's no adjustment required to the factored base year value. So essentially you're under that value cap, no worries. The child's base year value of $800,000 is maintained with a new transfer of the property, and it's the same as what their parents were paying during that last year, before there's that adjustment that happens each year based on what your obligation is. But that is measured per Proposition 13 on an annual basis, slight increase, but that's also capped. That's for a different conversation, but just want to give you a sense of this example. All right, so let's look at a different example. Next slide, please. Thank you. So let's say the death date occurs on April 3rd of 2021. We know that the factor base year value for that home is $400,000. The market value of the home is $1.6 million. So the home qualifies as a family home, right? Principal place of residence. And the eligible transferees filed claims on January 15th, 2022. So they're within the deadlines and timelines. So that part is taken care of. Now we have to do the value cap. How do you do that? $400,000 plus $1 million. You get $1.4 million. Now, what do we say? The market value of the home was $1.6 million. In this case, it exceeds that value cap. So it's the 1.6 million is greater than the value cap. So what's the excess? $200,000. That $200,000 excess is then added to the $400,000 base year value for a new number, a new assessed value of $600,000. And that becomes the basis for the new taxable value as of the transfer date. So again, it's not the $1.4 million value, assessed value, that's going to be grounding what your tax obligation will be. But it's also not the $400,000 value. The rule is applied. You add an additional $200,000 based on the rule to get that $600,000 number, but still much, much less than what that $1.4 million base would have provided in terms of a much higher property tax obligation you would have without Proposition 19. All right, so let's go over a few questions. So we have an owner-occupied multi-unit property. So we all know in San Francisco, there are many property types. You have multi-unit buildings. Some are owner-occupied and then transferred down to the next generation. So how would Proposition 19 impact an owner-occupied multi-unit building? The answer is that the child receiving the property would need to move into the unit that was previously the parent's principal residence in order to take advantage of the parent-child exclusion from reassessment under the proposition. The rest of the property, however, so say you have a 10-unit building, one of them was your parents, they transfer that one same unit to you, you occupy that unit, that's the only place where you are going to benefit from Proposition 19. The remainder of the multi-unit building is going to be increased to fair market value, and that value will determine what's taxed. So pretty big change there in terms of how you as a transferee who receives a property is going to have to think about your financing in relationship to receiving the benefit of just that one unit in comparison to the whole building and what your obligations are going to be. Again, planning is important, understanding the rules is important, and making sure that you are doing your due diligence to understand what your financial obligations are going to be in this new environment. Next slide, please. Okay. My mother's trust leaves her home to me and my two siblings equally. Will this property be subject to reassessment as of our mother's passing? So the answer is, again, at least one of the children or the qualified heirs must occupy that home within 1 year as their principal primary residence. Both the homeowner's exemption and Proposition 19 exclusion claim must be timely filed to qualify for exclusion from the reassessment as of the date of death. So again, someone has to move into that home, and it must be their principal residence. I'll give an anecdotal. Someone had parents who passed away in Los Angeles. Both children did not live in Los Angeles. They realized that they did not have the opportunity to move there as a principal primary residence, and they knew that then that property, since it would not be a principal primary residence, was going to be reassessed to market value, and the property tax obligation was not going to make sense to them and for them financially. And they didn't have the time to manage it in a way that would have it make sense for them, so they decided to sell it. That's one of the implications played out in real time, real life examples of choices that people have to make based on the costs that they're going to have to assume because of these changes. Next slide, please. All right. Filing deadlines. Again, deadline. Make sure you know what those are. Don't assume that one deadline applies equally across the board for every choice you have to make. We wish that were the case, but it is not, right? You have to make sure you understand what the different deadlines are. So again, here's one other question about that. So when inheriting a home, is there a specified amount of time that one needs to claim a residence as their principal residence to meet the criteria, exclusion criteria, Prop 19? When you say exclusion criteria, that just means that you're not going to be subject to a reassessment to market value. You want to be excluded from that so you can benefit from the factor-based your value, the lower amount carrying forward in your new environment, and for you as a transferee or receiver of the new home. So the answer here is the homeowner's exemption needs to be claimed within 1 year of the date of the transfer. If inheriting, the date of transfer in a case like this would be the date of death in which that transfer occurred. Is one example. The date of the death is one example of that. And then the parent-child exclusion claim must be filed within 3 years of the date of the transfer or prior to the transfer to a third party. So you want to make sure that you're understanding those two different components. An exemption that has to be filed within 1 year, and then the exclusion claim that has 3 years from the date of the transfer. Next slide, please. So here's another question. Two elderly siblings, they live in the same house. They own this property together, and it is their only property. If one sibling passes away, would the property tax be reevaluated or reassessed based on market value of their house? The answer to that is no. The transfer of a co-tenancy interest from one co-tenant to the remaining co-tenant, which occurs due to the death of one co-tenant on or after January 1st of 2013, may be excluded from reassessment if certain conditions are met. So there's some more information you want to look at there, and you can visit this section on our website, sfassessor.org, for more information and more information on the filing requirements. So again, keep on asking the questions as you're going through these iterations, these different scenarios that you want to be prepared for, so that you understand what to do in that moment, and you can be prepared. Next slide, please. Oh, I have one more that's about life estate. Did we pass that? Was there a previous slide on life estate? No, but I will read this one anyway, so we don't have this on the slide. So if the recipient, so this is different, it's not on the slides here. If the recipient of a life estate, remainder to the decedent's child files a deed reflecting this, is this considered a change in ownership triggering a reassessment? So the creation of a life estate in property is a change in ownership at the time of transfer, unless the instrument creating the life estate reserves such estate in the transfer or the transferor's spouse. So this one gets very complicated. Upon termination of such a reserved life estate, the vesting of a right to possession or enjoyment of a remainderment other than the transferor or the transfer spouse is a change in ownership. Mouthful, I know. You're going to want to reach out to us and make sure that we can give you the information that you can look at that will guide you or your agent in determining the particulars of your individual case. So here on this slide is the information about additional resources that you can get. This is the end of the proposition on Prop 19. So as I mentioned, because it can get very complicated based on certain questions or scenarios that you have, my staff is available in the office to help you understand. You can also look at the frequently asked questions and guidance that you see here. And there's a link to the Board of Equalization pages that provides even more in-depth information on Proposition 19. And then one final thing, as I mentioned, sfassessor.org is our website. Next slide, please. And just remembering, just in general, separating apart from this, this is just a reminder of key dates to keep in mind that apply statewide, all 58 counties of California. We begin our work with a lien date on January 1st. For every property, whether it's real property, business personal property, or possessory interest, our office looks at the assessed value and determines it based on that lien date of January 1st. And then our exemptions deadline is February 15th. Next on the timeline, we have June 30th. That's the date that we close the roll. That roll provides the information about total assessed value at that moment in time, so that we can, and the city can, plan for its financial choices that it wants to make based on the expectations of value on the roll. In July, as I mentioned, at the end of July, everyone who owns real property will receive a notice in the mail, a notice, not a bill, of notice of assessed value in the mail. And it'll tell you the assessed value for the year and include the exemption that you are noted to receive that year as well. So again, just make sure you read that to make sure it's accurate. Then again, in October, you're going to get the bill from the treasurer and the tax collector's office. And as I mentioned before, you have 2 installments in which you pay that one amount, that total amount. The first one in December and the second in April. For those who have property and possessory interest, they can expect to receive a notice and a tax bill in July. And so that due date is sooner. So just make sure you're paying attention to what exact type of notice you're getting, then the associated bills, because there are some different due dates. Hence, paying attention to timelines, deadlines is so important. Next slide. Again, you have any questions, we're available in person, by phone, or by email. We'll put this in the chat section. Please go ahead and reach out to us when you have a moment. And do make note of hours. If you're recording, you want to come in earlier than 5 p.m. If you have some of that business to take care of, because we do close those services an hour earlier, so we're ready for the next day. Well, thank you very, very much for your time. I think we're at time, but if there's any additional questions out there, I'm happy to answer any right now that might be quick to answer, or we can conclude. And as I mentioned, we're always available.
Thank you so much, Assessor Torres. We have a lot of questions that came through the chat. I think most of them, there was, your FAQs were very good and really got to a lot of those questions. And so I think we'll call it there. I will say I'm a financial planner, and so I talk with clients often who are going through transferring properties between generations or moving. And so I've called the assessor's office with a number of clients, and every time I've been very impressed by our dedicated civil servants, and they know things right off the bat. I think I'm giving them a corner case and they like, nope, very clearly it's over here. Don't worry. Yes, I can give it. And it's a really wonderful team you've got there. So highly recommend emailing, calling them. I've always been impressed.
Oh, thank you so much, Karen. And again, if you have an experience that you're not satisfied with, I want to know that too. Our team wants to know that too, so we can adjust, because that informs how we provide clear information to you, accurate information to you, so you can make the best choices in your interest. So thank you, Karen, very much for saying that.
Yeah. So thank you, Assessor Torres. Thank you, everyone, for participating. Up next, we have a tax update with Larry Pond, and we still have one-on-one sessions going with financial planners for the rest of the day. So please stick around. Thank you, everyone.
Thank you, everyone. Bye.